Are you ready to get real? Welcome to real estate, the world's loneliest career, where you're always out of balance, unfulfilled, the role models are fake, the numbers unattainable, and you're just supposed to be and do it all. Join self-made millionaire real estate agents, wives, moms, and business owners as we level up, learn from special guests, and elevate and disrupt an entire industry through real education our way.
Hi, everybody. Happy Tuesday. Today we have Crystal Stearns with us with North Point, and she is going to give us the down low on what is going on with the interest rates and the difference between good credit, bad credit, in between credit, what that means for everybody, and how we're supposed to figure out how to interpret it for our clients. So, without further ado, Crystal, can you please explain to us what the hell is going on?
Yes, I will try to keep it as simple and brief as possible. I have been in this industry for 17 years, so I am numb to constant changes, to where I'm like, okay, yep, here's another one. We're gonna figure it out. We're gonna find solutions. So I'm very solution oriented in these situations. First, I would like to say that these changes with the interest rates came out actually in March. And it was for loans that sold May 1st. And a lot of people thought that the rate was going to change May 1st. It actually already changed. So what it is, it's called Loan Level Pricing Adjustments. It's LLPA. When we look at an interest rate, we have different hits that we look at. So you'll have your base rate. Let's just say conventional starts at 6.5 today. Then we look at a little chart that'll tell us, okay, loan to value here, there's a hit, credit score, there's a hit, cash out, investment property, la, 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 la. So as an example, for a 740 credit score, putting down 20%, there is a hit that's an LLPA, so a loan level price adjustment. Well, it basically is a hit to the rate that the lender has to pass on to the client. So we can pass it on either as a discount point or it goes into increasing the interest rate. So where everyone is upset is that used to FHA loans were for higher risk borrowers, lower credit score, things like that. And conventional, you have the perfect credit, you have the big down payment, you should get the best payment, right? So that has shifted and kind of caused a frenzy, more of a frenzy than I think is necessary, other than the fact that we are using these adjustments to fight inflation, which is frustrating because I don't think that it's an appropriate, we're hitting on such a large investment for consumers to make up for inflation, and it just doesn't seem like a fair trade. But for example, on a $700,000 home, this is just a quick number I have for you. FHA 5% down with a 660 credit score, taxes, insurance, everything all in, $51.23 is a payment. Okay. On a conventional with a 740 credit score, the same 5% down, $51.36 is the payment. So that's where people are upset that have the higher credit scores and they're like, wait, FHA is a better payment than conventional. How does this make sense? Now, in the long run, I don't think the FHA makes sense because you have the mortgage insurance that gets rolled into the loan. So even though you put that 5% down, your loan amount is still higher. And then the private mortgage insurance does not come off like it can with a conventional loan. So as you know, once you hit 20% equity, 80% loan to value on conventional, the mortgage insurance comes off. FHA, that mortgage insurance is lifetime. So where this hurts people basically is the larger the down payment, even with good credit, it's actually dinging them worse. So there's a couple of different things you can do to avoid this. Obviously, you can put less money down. Sometimes what I'll advise clients to do is put 15% down instead of 20. The hit to the rate is lower. And then once they have 5% equity built in with our amazing market out here, then they can call their lender and have that removed. So that's one option. The other option is do the minimum, do the 5% down. If you have 20% down, fantastic. Take the other 15% and go buy an investment property. Or pay off other debt. And I always recommend paying off other debt first anyway. So these are the things I'll go through with the client. I'll look at their credit and I'll say, okay, what's your score? No matter what, I want them to get the best credit score. If there is 660, the likelihoods of me getting them to a 740 is tough. If I can, it's a miracle and I'll do it. It's still going to be more beneficial to have the better credit score. Not only does it affect the mortgage, but it also affects the homeowner's insurance as well. So people are like, oh, should I lower my credit score? Do I go late on a payment? No, absolutely not. the best credit is always going to be the best route. It's just, let's look at what down payment options make the most sense. So we'll put together like a side-by-side comparison, and we'll go over those options and explain. Now, the big kicker on this, I just had somebody reach out yesterday wanting to buy a second home. And last year, this rule had changed on second homes. Used to, second homes, we could do 10% down, and the interest rate was the same as a primary residence. That changed in March of last year. Now it is the same hit to the rate as investment property. So a 10% down on a conventional second home, the LLPA, so that adjustment is 4.125. And you really can't roll that into the rate right now because the margins are so tight right now that it's not an option to say, oh, let me take your rate from 6.5 to 7 and roll those 4 points in. That's not a thing. So what they're having to do is they're having to pay that in discount points, which makes your closing costs really high. So I had to kind of give the bad news to that client of like, hey, we can do this, but man, it's going to cost you. So again, I will find a solution. Like if you're going to put this much into it, you might as well take those 4 points, put a little bit more down. If you put down more on a second home or investment, if you do 20% instead, then that number drops from 4 to 2 and buy down. So different things like that we'll look at. We also have like a DSCR loan. So sometimes that makes more sense for people, which allows them to qualify based off the rent of the property rather than income. The rate's higher, but the points are lower. And I'm all about what's the cheapest way I can get you into something. Because to me, at the end of the day, like cash is king and that makes more sense. And then one other caveat too, where this is affecting people is on cash out. So again, the government's coming in, they're taking advantage of us and saying, hey, you, the people, have a ton of debt right now. The most that we've ever had, by the way, the government as well. Like if you compare the debt for the government from 2008 crash to now, it's astronomical, but same with consumers. I'm talking 6 figures in credit card debt right now. Okay. So I know people have mixed feelings about cashing out of their house to pay off debt. I 100% am all for that. And this is why. If your credit card is 24% at $100,000, I would much rather you go borrow $100,000 in equity that because you made a good investment, you have now gained kind of like free money that you're getting to borrow against. Now you can use that and you can pay off your debt at, I don't care if it's 8%, because it's better than paying 24. Same with cars, whatever it is. So again, everyone's situation is different. I go through all the options with them. This is not a one size fits all. So don't come at me for if you think that my advice is wrong. We can discuss it. But overall, the cash out refi now is a much higher hit to do that. So again, the government is looking at where can we make up for this inflation, and they're dinging kind of the places that I feel like hurt us the most, unfortunately. So cash out refis is going to cost more. There's going to be some more changes in August. The good news with all of this is as inflation does come down, interest rates will as well. So we're waiting for May 10th to roll around, which is tomorrow, to see the inflation numbers. I felt really good about this, and now I'm kind of backpedaling. I don't know that we're going to see a big difference tomorrow, but maybe in August we'll see a big difference in the inflation numbers. So long story short, we're paying the price in mortgages to make up for the inflation.
Yeah, and I don't think it's just mortgages either. I mean, I'm shopping for car loans right now, and normally when you're buying a new car, they give you all these fun incentives, right? Not right now.
No.
Their fun incentives are 7% on a brand new car. That's not a super great incentive, right?
Right,
so
right.
Who are they trying to help here? Like, who is benefiting from all of the massive amounts of, we're getting hit from every angle. We're at the grocery store, we're getting hit. We're getting hit on the home side. We can't even buy a second home. So what the hell are we supposed to do with our money right now? Like, what is the best play?
It's a good question. Well, when you mentioned the car rate, so car rates are based off the Fed rate, and the Fed rate just increased, which was really disappointing because inflation numbers were actually good. And so we expected to see a positive movement in the market and the interest rate market. Instead, it spooked the market and rates went up a little bit. And I'm like, what are we doing here? So the Fed rate went up. That's what affects your HELOCs. That's what affects your car loans. And then eventually affects the mortgage rates as well. So the inflation is, well, not to get political, but it's government. The government is protecting themselves. They're charging the people in every way they can. We saw what happened with eggs. They created a shortage in eggs. They were able to up the price. It's just this constant thing. So right now, I think it's all about protecting yourself. It's all about protecting your dollar. The value of the dollar is unfortunately going down. So where can you make wise investments and still have access to your money? I don't think dumping it into real estate all in is the best idea. I think obtaining as much real estate as you can with as little as possible is a route to go. So when I get clients who are moving up and they made $100,000 in equity and they're like, cool, I'm going to dump it all into the next house. If they need to for their comfortability or for qualification, absolutely. But a lot of times they don't. So I'm like, hey, you have 100,000, you really only need 25. Why don't we look at taking the 75, put a little bit in real estate, put a little bit over here with the financial advisor, get a good financial advisor who's protecting your money. Because my stuff right now is about 17%, even with the rough market. I'm gaining about 17% in my financial advisor money, stocks, whatever. I don't even know what he puts it in. My housing market stuff is doing the same. But what you don't want to do is dump it all into there, and then you don't have access to it. And as these cash out refinance hits are coming, things are getting a little bit harder to do. You're not going to have access to your money as easily. So keep it as liquid as possible to invest in smart things. And in real estate, not because this is a real estate podcast, real estate's where my heart's at, because that's where I made the most money. That's where I've seen people make the most money. You look at millionaires, billionaires, that's where they've made their money. I feel like it's a very safe investment in our area, especially. I don't see any chance of a housing crash. We still have a major inventory issue. We have a great economy here locally with the military, but we also have great economies nationwide. I own properties all over where they made sense for the economy. So I still think that is the safest place to park your money, and just keep as much liquid as you can.
So if somebody were trying to purchase an investment property, how much down would they need to have? And what kind of, whether it's investment or second home, I feel like they're similar because you're buying a second home for a reason, not just for your health. You're buying it because you want an investment that's going to turn money, right?
Mm-hmm.
Like how much down do you need to have right now? And is now a good time to buy one of those?
That's a great question. So the difference on the lending side for investment versus second home is a second home is intended to be a vacation home. You are allowed to Airbnb it for a certain amount of time. You cannot have it as a long-term rental whatsoever. And they do watch that, not us directly, but there's eyes on that stuff. So you don't want to be sneaky with it. And there's really not a lot of advantage anymore of trying to say second home versus investment. But for investment, we will use the rent that the home will bring in with a rent comp to help offset that payment. So that does help you qualify. So the minimum for second home is 10%, but I don't recommend it because of how high it is. Yeah. The minimum for investment is 15%. Same thing. I don't recommend it because how high it is. You're getting hit in points and you're getting hit in mortgage insurance. I recommend on an investment or a second home to do at least 20%. 25 is a little bit better. It does help you a little bit, but I recommend 20%. And I definitely think that in the right markets, it's good. So look at markets that have growth. For example, I bought in North Carolina because Apple was coming in with 3,000 jobs. I bought on the cheaper side of North Carolina. It was a 30-minute commute to where Apple was going in. So I figured the people that, work remote or okay with the commute, they would like to have cheaper housing, half the price in rent. So look at areas that are doing that. Again, I don't think you can ever go wrong in Colorado Springs. The only caveat of going to like a North Carolina or another less expensive place is that your cash flow on rent might be a little bit better. But the way I look at it is all about appreciation. I'm not focused on how much I make per month on my rental. I would like to break even. Sometimes I don't. Sometimes I lose a couple $100. But my goal is to break even. But the bigger picture is the tax deductions, number one, which get with your CPA on that because you'd be surprised how much that really helps you. I'm W-2, so I do not get the advantages of writing things off. So I have to have other things to write off. Real estate helps tremendously with taxes, whether it's a primary, a second home, or an investment. So that to me is key. And then the bigger picture, again, is the home appreciation. I don't know what your statistics are for this year, but the last I heard was 17%. I can't go put cash in a bank account and make 17%. Now my stocks and bonds and stuff have done well at 17%, but it's kind of hit or miss. So if I can go park my money somewhere and have a home and have something tangible that I can rent out. Someone else is basically paying me for my investment every month. And let's not forget, the money you put down is still yours. You still have access to it when you sell it, or you can cash out. But in the meantime, that monthly that's going every single month, somebody else is putting that monthly in for me, is how I look at it. And then I also look at, again, bigger picture, generational wealth. I want to have enough homes for my children, because I bought a house in 2014 for $275. It just comped out at almost $600. So what does that look like when my 4-year-old wants to go buy that house? $2 million, you know? So if I can get established real estate that way to then pass on to my children when they go to college and not have to pay rent or pay dorm fees and have an investment, they can do what they want with it. They can keep it, live in it, sell it, whatever. So that's like the very big picture of how I look at real estate. I have 14 properties, and those are like my angles. So when people say, oh, what about cash flow? You know, I heard I should cash flow 1%. You're not going to be realistic and see what your bigger picture is.
Yeah. Lindsay, I'm sure that you saw it up there in Denver because it's all over the news. Here in Colorado, our property taxes have gone up to an asinine amount for pretty much everybody. So you're going to start seeing every realtor in Colorado posting about, here's how you fight it, here's what you can do. What are you guys seeing up there as far as an increase, Lindsay, in the Denver metro area?
35 to 70%. So my mortgage payment just went up $583.40 a month, which is awesome. So, I mean, the squeeze right now is just unbelievable. Like Angela said, it's coming from every angle. It's homeowners insurance increases. I've seen people saying that their homeowners insurance has doubled. I haven't had mine reset for the year yet, so I'm worried about that too. Taxes. I mean, I'm really starting to worry that this is the stuff that's going to cause a housing crisis, because there's a huge difference, right, between a recession and a housing crisis. Like, historically speaking, in every single recession outside of the Great Recession and the Great Depression, home values have actually increased, right? Great Recession was a housing crash, and it's starting to make me nervous that we could cause that by accident, because the number of people that we already know are defaulting on loans and things right now is really high. And when you're increasing their mortgage payment by hundreds of dollars a month and you're increasing their insurance by hundreds, it's scary. So Crystal, you brought up something super interesting. Should everyone with equity cash out? Because equity is like monopoly money, right? It's only there if the property is worth a higher value. So if things start to slide a little bit, should everybody do a cash out right now and pull what they can?
People are, I view things differently. I do things differently, but I've made it this far. I close about 600 loans a year. I'm a single mom with 4 children, and I'm doing okay. So this is just my personal advice. This is not for everyone. If you're paycheck to paycheck, these taxes and insurance are definitely going to hurt you. And it does scare me. The amount of debt that I see that people have incurred this past year, it scares me. I would say if you have equity, I would say definitely something to consider, definitely something to look into, whether it's a cash out refi or a home equity line of credit, because you can have that line of credit sitting there if you need it. At least you have that there for security and safety. I don't think that we're going to have an issue of a crash like we did in 2008 because we still don't have inventory. But here's the hard part. My situation personally, I put a lot of money into remodeling my house. It's beautiful. I'm bored. I want to go on to the next one, like Angela. So, I mean, Angela, you stayed in your last house for a long time, but I do it. Like, I've only been in it for a year, and I'm like antsy. And so I'm like, well, I mean, you know I can take this money that I put into it and go buy something else. There's nothing out there. Right. There's nothing else out there that fits. Like I said, I have 4 children. I need a 5-bedroom, and we need to live in a certain school district, and blah, blah, blah. And my kids are bougie, so it has to be nice. So what are you going to do? Yes, you could sell and take that profit and go try to buy something else, but there is nothing. You want to go rent something, your payment's even higher. So I do think to have kind of that security and have just money available for inflation, for groceries. Gas is supposed to go up again. I have a Tesla for sale if y'all are scared of gas, let me know. But like, there's so much that's just this continuing. Like we said, I mean, food, I can't believe how expensive food is. And so I do think just to have that is smart. It's going to be cheaper than a credit card. It's going to allow you for a lower payment than a credit card. It just, what are you comfortable with and what makes sense? Because what I don't want is someone to max out their house and then they lose their house because they took out a $100,000 HELOC and they went and bought a freaking boat and now they can't pay for anything. Like, obviously we have to be smart here. So if people are interested in that like I kind of am a mama bear, and I will have that long conversation of like affordability and make them write out their expenses and make them get nitty gritty. And if I see that they're eating out every single night and they're complaining that they don't have money left, like, let's reel it in. So I think right now, we need to get serious. I don't care what income bracket you're in. I mean, in the mortgage and real estate industry, we've killed it for the past couple of years, and then it got pulled from underneath us. And it's time that all of us kind of hunker down, no matter what industry you're in, and start thinking about these things. Where can you cut expenses? Where can you save? What can you sell? What side hustle can you do? There's still things out there that people need. And I do think it's important we start thinking about those, because not only do I think that the all of this stuff with the mortgage is impactful, but we are going into a recession. I think we've been in a recession. I think we've been able to, kind of skate by, but until something changes politically, we got to buckle up.
Yeah, no, I 100% agree. My main concern for our market, which Crystal and I are both in Colorado Springs right now, but Crystal lends pretty much all over the place, all over the country. But in Colorado Springs, my main concern with these property taxes going up is one neighborhood in particular that's going to be affected really, really hard by this, and that's Lorson Ranch. So Lorson Ranch,
they're already so high.
Lorson Ranch already has the highest property taxes in like Colorado. And basically it's all military folks that live there. So if they're already getting hit hard by that, an extra $200 to $600 a month is going to kill them all. I mean, they're not going to be able to afford it. So they're going to dump houses like it's going out of style. House values in there are going to go down tremendously because everyone's going to be dumping them at the same time. That's my fear. That's what I see happening anyway. Or we're going to have massive amounts of people defaulting in there. I don't know. What do you
and insurance. Oh, sorry.
What do you think?
You had mentioned insurance. I had met with an insurance agent a couple of days ago, and he had said he's been doing this for 20 years. He said that because of the Boulder fires, they're now labeling brush fires and like flying horse. I mean, where is a brush fire and flying horse?
I just had a client who we had to terminate on a deal that we had under contract because it was uninsurable in monuments and nowhere near trees. But because now they're considering that a fire hazard area in monuments. And there wasn't even a tree on the property.
We have to fight it.
And it was uninsurable. Like, we talked to over 50 insurance uninsurable. Not it was really expensive, uninsurable. So I just don't I'm starting to get pissed off, which is stupid, but like I really hope that other people are starting to get pissed off, because I think that something it's going to have to change. Like, we've been saying we don't want a housing market crash, and then we're pulling stuff that is squeezing people so hard that I don't know, what's going to happen. Like, and
what would you do differently if you weren't trying to force that? Nothing. Like, this is how
the entire squeeze is coming down on housing.
Yeah.
Well, and then the government doesn't understand the situation that we're in. We still have an inventory issue. We have an affordability issue. So what do? They go to California, one of the highest states in the country, and they say, hey, here's 20% down, free money. Come and get it. Well, what do you think that did to the market? It just pushed the prices right back up. So you already have people that affordability is a huge issue. There's not very many people that can afford to have a single home household. They need a roommate or they need a spouse or something, because it's almost unattainable right now. And what they're doing is increasing it and driving it. Now you're increasing interest rates. So now you're driving the payment higher. Now you're increasing taxes.
Angela and I were talking about this last week. I know none of us know for sure, but do you think that in any way that's the play here? Like, is the play, let's come in as hard as we can and crunch people as hard as we can, and then let's, right before election season, like, do something to look like
bail them out.
A winner, give a tax credit, bring the rates down, that is pure market and election manipulation. And it's something we've seen before across party lines, period. But
no, I agree. I agree, but that's hard because we're in such a high inflation. So it's like, well, where are you going to get the money for these tax benefits when you've been kind of screwing us on everything else to fix your inflation, and now you want to offer this? But there's definitely some type of a bailout situation. I mean, we saw during COVID, they extended the bailout situations in COVID, for the election. So it is very political, which I think is so frustrating. Why are politics in housing market? This is people's homes. These are roofs over our heads. Like, why are you involved in that at this level? And I just hope that Fannie and Freddie can get it together to go back to being, independent again, like they were before the government took over, which rightfully so the government took over. But it's been a while, guys. Like, that was 2008. I think that Fannie and Freddie have, trust me, my handbook is, 1,200 pages that I have to memorize for guidelines. Like, I think we're good. But I don't know. There's definitely a political pull to this. I definitely think the government housing grant was a political pull, but it's not helping anything. It's hurting it. And it breaks my heart because, like we were talking about with military, I mean, military is 60% of my business are VA loans, okay? Yeah. And only 25% of all loans nationwide are VA. So when I get these young soldiers that are like, my BH is 2,200, I need to keep my payment at that. Okay, go find something for $350. Oh, there's not anything. Yeah, I know. Oh, you found one for $380, but the taxes and the insurance. I have one right now. The insurance is $3,200 on $380. I said, yeah, y'all are good at $380. No, they're not, because the property insurance is so darn high. And so that's where I get really frustrated and, like you said, pissed off and disappointed, because I'm like, what are these people going to do? And if you know anything about base, that's what I'm saying. Yeah, if you know anything about base housing, like that's the last place that you want them to be. And so it's like, how do we make this make sense for people? So right now I say, as an industry, our 3 focuses need to be fighting this ridiculous homeowners insurance over Boulder, which Boulder, I have my own theories on what happened there. Secondly, fighting these property taxes. We have to do it. We have to educate the public. They can't brush this under the rug. Like, everyone has to come together, and hopefully this doesn't happen again, because the county gets so overwhelmed and goes, okay, crap, what did we do? And then next is, we really need to be educating people on, like, getting their crap together. Like, we don't need to spend money on unnecessary things right now. Like, you need to focus on your home. You need to focus on saving, whether you're saving. I consider a house a savings account, an investment account, but we need to show people. So I have a budget worksheet I have people fill out, and I'll match it up with their bank statement, depending on the client. I don't do this with everyone. It's the ones that need it. And I'm like, oh, okay, you bought a Kirby vacuum when you're paycheck to paycheck? Why? You financed a $3,000 vacuum? Like, those are the tough conversations that we need to be having. And there's not an age group here, and there is not an income group here. It is everybody that I see this with. So it's like, okay, you need to ask for a raise at work, or you need to find another job. You need to cut these expenses. You need to get down to the nitty gritty. You need to meal plan. Like, we're all guilty of eating out too much. So I rely on HelloFresh because my kids can help make it. We're not blowing a lot. So those are the tips and things that I'm telling people right now, because unfortunately it's not going to get better until the election's over. And even then, who knows what's going to happen.
Mm-hmm.
There's got to be a play, because I just feel like with the way that things are going right now, how could you reelect the current administration? Like, it's just thing after thing after thing after thing. So I've got to feel like they've got to come in and do some.
All I can do is say, hope and pray. People really need to educate themselves, because they need to understand what politics really mean. It's not a popularity contest. It's not a celebrity telling you who to vote for. It's not, this party against this party. It's truly like, how much is right by the people.
What is your interest rate? Yeah. I know that's what you vote for. And I mean,
if this doesn't show you, like, and again, it's not, I don't care who you vote for. I don't care what side you vote for, but educate yourself on what it truly does impact. And don't listen to the noise and them trying to divide you by your political party. Like, let's actually look at how this impacts your family right now.
Yeah.
And affects affordability right now. And people that could buy a house 6 months ago that no longer qualify because everything went up.
And read the fine print on every single, like, don't just like check the boxes down the ballot, because what happened here in Colorado specifically with that repeal of the Gallagher Amendment is what caused those taxes to go up so high. And that was stuffed into this bill that was like really pretty and really sexy. And of course, if you didn't read it, you would have voted for it. Right. So like, you've got to really, I mean, voting is it's a huge responsibility. We need to treat it as such, but
well, I mean, even like how it affects the schools, people are like, my kid's not in school, I don't really need to worry about the vote. But you do, because it does impact your taxes. It does impact the economy. It does impact where people want to live. People they go to the good school districts for a reason. So there's just so much into it that I think that we've been oblivious, including myself, to where we're like, man, I'm just one little piece of this pie. I'm not that significant, but you are. You have to get involved. You have to educate yourself. You have to educate other people, because this is, I mean, honestly, like, this is the first time that I've been scared.
Yeah, me too.
And I went through 08, but I went through 08, like brand new baby loan officer, didn't really know what I was doing, didn't have a lot of expenses, but now I'm kind of like, I'm nervous more, not so much for myself as I am for everyone around me. You know what I mean? Like I'm very, I know my clients' situations very, very well. I'm very intimate with their files to where I know their story. And those are the ones that I'm scared for.
Yeah.
So your buyers that are buying right now, where are they coming from? Why are they buying?
So I work with a lot of military. It's PCS season. So that's the majority, but we're struggling. We are struggling so hard because, I mean, anything under 400,000, it's a bidding war. Well, there's bidding wars on all prices, but a lot of these guys are coming in and they want to be under 400,000, and there's not a lot out there. Number one. Number two, there's bidding wars, or it needs a lot of work. They have a lot against them. And I'm telling them, hey, you know what? You with your lifestyle, you're a single guy or gal, go get a roommate. Just do it. Just get a roommate. At this point, like, that's what you have to do. Yeah, it sucks, but you'll make it all right. It's better than living, in base housing. So that's part of it. Is a lot are military, and then I kind of have just a clash of different people. We have a cool loan that is more for like higher earners. So I'm getting quite a few that are wanting that loan. I'm actually getting quite a few construction loans, which is surprising because construction's expensive right now. Dirt's expensive right now. So quite a few of those. So I really have a mix right now. I do have a couple of FHA. I just did I have a Chafa closing this week. Haven't done one of those in a while because the rate was so darn high. Yeah. But now the rate's about the same as everything else. So yeah, my buyers are kind of from all over, just word of mouth. That's where I get all my business.
And what's the overall sentiment like when they call you? Are they like, maybe I want to buy, but I'm afraid of rates? And then or is it like, yeah, I really want to buy, and then you tell them the rates and they're like, or like,
no.
What's the overall pulse of buyer?
It's actually a mix. I have one right now that she's coming from one state completely to another. She's like, well, I have a 2.75 right now. I said, congratulations, you'll never see that interest rate again. And I said, keep that house if you can. So she said, oh, what's the rate? And I said, 5.75, 6. And she's like, I'm not buying a house at 6. And I said, yes, you are. Because I looked up where she's moving and I said, you have a 16% appreciation. You're going to pay 6 to make 16. Why would you throw away money on rent? And then the other ones, the biggest issue is they don't realize the payment. Yeah. And when I tell them, they're like, oh yeah, I'm comfortable with $2,000. And I'm like, well, that $400,000 house is going to be $2,500. That's where I have people struggle. I think we've lost a couple of buyers due to that because they kind of like ghosted me after I told them. And then I get the people that will shop my interest rate, which go for it. Like, our rates are super competitive. And I'm the first one to tell you, I watch my friends' rates and I'll be like, yeah, you know what? So-and-so does have that. And I do trust them with that loan. I'm not going to give it away, but if you're going to shop me, I'll let you know if they're good or if you should avoid them. But yeah, the big thing is people, it's a sticker shock of the payment.
Yeah. Especially in our market, because it's so military driven. People don't think in terms of interest rate or total purchase price. They think in terms of monthly payment and monthly output.
BAH.
Yeah. In our BAH, there's such a disparity between what they're actually getting and how much it costs to live here. And I don't understand why it hasn't quite caught up yet. It's not even close. Like, I looked at BAH the other day for an E9 just for funsies. And I was like, they can't even afford like a $400,000 house with that. Like, what? For an E9?
Yeah, because used to you could have your house payment and your utilities covered by your BAH, and right now you can't even have your house payment covered by your BAH. And it wears on me. I'm an empath, and I'm a very like emotional, sensitive person. Especially just lately, I think just with everything going on, it really stresses me out because I really do feel for these people. I have a family, a young family, and they're really struggling to get this house right now because the taxes are, the insurance is so high. I have them over with Val at Mortgage Solutions because I couldn't get it done, and she's scraping to get it done. And I'm just like, they're just young and they made some credit mistakes, and now they're just trying their darndest to make this work. And it's like, they can't really afford it. What do? And I do have those conversations about cutting expenses. A lot of them will listen. They're coachable. They don't realize it. I used to, like, my little brother was in the oil business, and he, at 20 years old, you know, made 10 grand a month, had nothing to show for it. And I said, I want you to write down your expenses every single day. That boy stopped at the gas station 2 and 3 times a day, right? That was where he would take his break because he's sitting on the oil field, and he would buy cigarettes, and he'd buy soda, and he'd buy chips, and he'd buy hot, whatever. And so every single day he spent like $100 at the gas station. So I tried to show that to people, like, $100 a day is absurd at a gas station, but it happens, or Starbucks or whatever. And every now and then, please treat yourself, drive the car that makes you feel good if you can afford it. But at the same time, like, it's okay to also cut pennies and to watch where your spending is going, because at the end of the day, what's important is that nest egg. And we don't want to work till we're 80, you know? I mean, at least I don't. Angela probably be slinging houses at 80.
Fuck, I fucking hope not.
It's crazy. I mean, I think we're going to see this huge shift in where people are living. Like, I think the Midwest is going to blow, and the South are going to blow up, because every one of my sellers, they're all leaving the state, and they're going to places
that's already happened.
I mean, Missouri, Tennessee, you know, Arkansas, Idaho, and it's, you know, it's like, I don't know why you wouldn't. Like, you could take your equity from Colorado.
Because it's hot.
Yeah, it's hot as balls. And they have mosquitoes.
And there's mosquitoes the size of your face.
I'm okay with all of that. But, you know, I think it's just like how nobody's going to be able to get started here anymore. We have turned into kind of California. It's crazy. So
we are, because we keep taking their advice. That is the worst state. Like, if you're looking at it as a model for business, why the hell would you follow what they're doing? It is a shit show over there all the time, 24/7. And now we're turning into it in Colorado. Like, why are we doing this? It's like,
it's so funny because every thought I have, you like touch on what I want to say. It's like, that's exactly what I started to say was California. So I bought 2 houses right outside of Austin, Texas. It's called Del Valley, because Tesla's Gigafactory came in. And I'm a Tesla fan. And so, just not because of the car. Well, it is because of the car, but I'm not a car person like as much as Angela, but it's the technology, it's the jobs, it's the just like the future. Like, I think all of it's really cool, even though I can't hook up a camera to get on a Zoom call, but that's okay. Anyway, so he put in this huge gigafactory. So I was like, well, this is an opportunity to have a rental, have, like, you know, the employees stay there while they're waiting to build something. So I built 2 brand new houses for $260. Granted, they almost look like a trailer house from the outside. I didn't know that when I bought them, but that's fine. They're super, super cute inside. Angela, you'd love the decorations. One's Tesla theme, one's boho theme. And the value of those a year later went from $260 to like $350. Well, now what's happening is Tesla can't keep enough engineers staffed in Texas. So he's talking about going back to California. And I'm like, what is that going to do to that market? Austin's already slowing down because the Californians, they came in there and they bumped up the market. Now they're like, meh, I'm going to go back. But they came in because there's no state tax. There's no state income tax in Texas. But now that's starting, you're seeing that, and the same with Tennessee. Tennessee's is 1% or whatever. So a bunch of Californians came in, they're slowly coming out. Now, where this opens up opportunity for us normal folks is the prices are starting to kind of chill out over there to where it is more affordable to move. And that's why I bought rental properties there and North Carolina, because the return on my monthly is higher, but again, the appreciation's a little bit slower than here. So I don't know. I feel like Colorado is still the place to be. I think about it all the time, like just sell everything and get an RV and just move somewhere. But no, I'm not that adventurous. I just don't think you can beat Colorado's housing market or Colorado Springs. Even when the crash happened, we were so quick to bounce back.
No, I agree. I feel like there are a couple places where people from Colorado have been moving their money very strategically or non-strategically. They just want to move in case the shit goes down here. And I think one of those places is Florida, basically the whole damn state, not like a specific area, just the whole damn state.
For sure. Yeah.
I got one in Florida too.
Yeah. The coast of Alabama, North Carolina, some parts of Georgia, and then the Kentucky, Tennessee area, and then some parts of Texas. But I feel like most Coloradans are afraid of what could happen in Texas now because of so much California influence. And then I know a lot of people, where do we vacation when we leave here? We all go to Arizona for some reason. It's hot as balls there, but a lot of us are going down there.
But it's dry. It's a dry
We can
heat.
handle that. We can handle that. For like the Florida heat, we're like, ugh, this is going
Uh-huh.
it's nasty.
But Florida, I can't visit after May. I'm like, that's my cutoff.
Yeah.
I think
But
it's
that's
going to
what's
change.
happening.
It's going to change a lot. I mean, people purely cannot afford to live here anymore.
Right.
Right. So
They're
they're,
gonna move
or they don't want to, you know, like I could take the cash in my house and I could literally buy in one of those southern states cash, and then I could live for
Yeah.
3 years without working on top of my equity, you know? So I
Right.
think we're going to see, and people are moving for politics for the first time in history. So
Yeah.
Right.
it's pretty weird right now, I feel like.
But that's what keeps me here is because I'm like you just said, you can take the equity. I look at it as free money. I don't know how other people feel about it, but again, my mind is very simple on how I view things. And so I look at that as free money. If I can take that and go buy something cash somewhere else, but then I'm like, but why stay in Colorado and just keep doing that?
Oh, I'm not saying that people should leave Colorado. I'm here for life. I'm just saying that, and I believe in Colorado and our housing market. I'm just saying I think that you'll see over the next year to 5 years a complete boom in the Midwest and the less expensive places to live, because people are going to get crunched so hard that they don't have a choice.
I think
that's
Iowa,
go ahead.
Idaho, and the Ozarks are probably up next for the booms. So
it's already happening in
Idaho already got hit. They're very similar to Colorado. I just think for investment purposes, it's still just with the growth here. And I feel like Colorado Springs has done really well with the growth and with the places that they've allowed to come in, like Great Wolf Lodge, like that whole area with In-N-Out Burger still has a freaking line every time I drive by.
Yeah.
I'm not a fan, so I don't stop, but they did well on like what businesses came in that I feel like helped our economy even more. But with the military here, I feel like you can't.
But that's what's so funny. Like, I do all my stuff and shopping on the weekdays because it's like a panic attack to go places on the weekend. But I was out with my mom last weekend. The mall is so busy. Like Park Meadows Mall, like you literally.
That's where I was this weekend.
You have to park. You have to park 3 freaking miles away to even go in the stores. Like every store has a line at the checkout counter. You have to wait in line to get food, and it's the funniest thing to hear. We're in a recession. The economy is terrible, and then look around and be like, you can't even walk in here
because people don't care. They just put on a credit card. That's why they're $100,000 in credit card debt. They don't care. It's a different mindset. I remember like after the 2008 crash, I remember going into a restaurant, and I remember Chili's used to have good food back then. Okay, don't judge me. It was good back then.
I'm a Chili's time.
It's so like, I don't know, fake now to me, but I remember going and I would walk in and there would literally be like 2 people, and I would like look around and it would freak me out where I wouldn't want to stay. And then I remember going into stores, same thing. Everywhere you went was almost like a ghost town because people were in panic mode. They didn't want to spend. Now they're like, you know what? Screw it. They're like, I'm going to go buy what I want to buy to make me feel good. Like the Lululemon store is packed at $200 for a sweatshirt. Like they don't care.
But I think half of it is the bullshit narrative. Like, oh man, I'm about to jump on the soapbox and yell. I think half of it is the bullshit narrative that the 50 million real estate agents in every city are spewing, which is like, oh, we're just having a little speed bump in the last 2 to 3 years is what's normal, and we'll get back to it. That is not the truth at all. That was the abnormality. Now we're in the real world again. And all these people going, oh, don't worry, interest rates are going to drop. We're going to see 2s, 3s, and 4s again. Just, marry the house and date the rate, right? Like just buy it at 8% and then refinance when it hits 2 again in June. Oh, now it's not June. It'll be July. It'll be August. It'll be September. It'll be October, right? Like, I think that there's a lot of people out there. I don't understand how 2 years worth of historical data became like the expectation or what's normal.
Thank you. Yeah. That's what I keep telling people too. I'm like, yeah, COVID was great for interest rates. That's all it was good for. Right. Businesses were ruined. Lives were ruined. Marriages were ruined. Divorce rate was up 40%. Suicides were up 60%. Yeah. Okay, cool. It was a shit show. So yes, you got a 2.75 rate. Congratulations. That's not going to happen again. It was artificially low on purpose. I do think that I will see government rates. Right now we're in the high 5s. I do see them going back into the 4s, hopefully by the end of the year. But I've been at this for a long time. Back in my Countrywide days, for those of y'all that don't know what Countrywide is, we were selling 7%. 7% conventional was a good rate. And you know what people would tell me? Oh my gosh, I'm so grateful for the 7%. My first house was 15%. And now I have people over here that are like, I'm not buying a house at 6. I'm going to wait till they're 3. I'm like, that's not going to happen.
No, because I don't like, I don't understand why realistic data and narrative can't get out to the world. Like, it literally is making me psychotic.
Because they tell you what you want to hear.
I know, but I think you nailed it a little while ago when you said that the people that know the truth have the responsibility of continuing to share this information and educate people on a really like nonstop high level, because this is it's the dumbest thing I've ever. The only reason that rates were as low as rates were was because we were in fucking trouble, right? So the lever that the United States of America, the world, pulls in order to stimulate an economy that is dead and flat and fucked is lowering interest rates. So a 2.75 interest rate is a sign of a terrible fucking time in the country. The 7% interest rate is the sign of a healthier economy. Like, people don't get it. So the only reason that we're going to pull that lever again is if shit really hits the fan. If we actually go to, World War III,
we go to war,
we're going to need.
If we go to war, nobody's buying houses or worrying about their mortgage. So that's not going to happen either. But yeah, I try to educate people on that. Like, and again, the big thing is like, okay, what is the cost of waiting? And here's my thing is I don't like to ever advertise or market or mention anything that I cannot come through with. I am not going to tell you that you can assume a VA loan. I'm not going to tell you that. You know why? Because the likelihoods of you doing it is slim to none. It takes 90 days to do them right now. The qualification process is not easy. I don't get paid to help you assume a loan because you're just going and taking someone else's. The investors don't want you to assume that loan because they want to sell you a 575, not a 275. And the money on the back that you need, you can't take out a second loan and just take it to the bank like that. You have to go get other money on your own that is not attached to the house. They will not allow a second mortgage. So what is the realistic chances of you waiting 90 days to get approved, having $100,000 in cash, going through the process and hoping that the bank accepts it to be able to get it done? In the meantime, you just wasted 3 months. I could have already had you in something that you actually loved, that you weren't settling because of the stupid interest rate. I don't care what my rate is. I'm not going to go live in this house instead of this house because my rate is 3% better. That logic doesn't make sense to me. So I get frustrated when there's like that false news because then you have to backpedal and say, well, actually, so yeah, rates are what they are. The cost of waiting is real. The cost of waiting is the houses. Like, it's so crazy because on Facebook memories, like stuff will pop up. Yeah. It's really annoying with these people walking behind me. Sorry. My Facebook showed a house the other day. I think it was like 8 years ago or something. And it was like 193,000. And I looked up that house and it's like 500. I know that's 9 years ago, but even month to month. Like, let's look at what happened last summer or summer before last when people were having to bring $40,000 to the closing table on a house they didn't even want, but they just wanted a freaking house. So they wiped out their savings account, $40,000. So I'm like, that's what I keep telling clients now. I'm like, if you end up in that situation, you're done. You're done. You're probably never going to buy a house unless something drastically changes in your life or in the market. You're done. So the longer you wait, hoping rates go down, it's costing you money more and more and more.
And if the rates go down, prices are going to skyrocket.
Oh yeah. As soon as rates dip, which again, we'll see what happens tomorrow, but as soon as rates dip, it's going to be a frenzy.
Yeah,
it really is, because that's how people know. Like in my industry, that's the first thing people ask, what's your rate? What's your rate? Like, I'm like, well, what's your credit score? What's this? Like, there's 80 other things involved. And I'm like, rate is not the most important. I can get you whatever rate you want. How much do you want to pay for it?
Yeah.
Yeah. Or you can go down the road and maybe find a broker who works out of the trunk of their car who doesn't have to make as much as I have to make, and he can give you all his commission and get you a little bit better. Are you going to close on time? Is your data secure? But again, that's all that they know is to say, what's the rate? So then I'm like, okay, cool. What's the rate? Yeah, rate's important, but so is payment. How about your earnest money? How about closing on time? So anyway, it's a constant thing, but that's where we have to educate more and more and like look at the bigger picture. Buying a house makes more sense than any other investment, in my opinion. Again, not because I'm in the industry, just I see people's financials all day long. I can tell you where the wealthy put their money. You know what I mean?
Right.
Oh yeah, absolutely.
Yeah. I mean, at least if you're putting your money into a house, it will appreciate eventually. If you're putting it into something else, it's hard to know what it will do. It's super volatile. Real estate is the easiest brainless investment that you can make. Literally, all you have to do is just dump your money into something, and eventually, as long as you made a decent decision, it's probably going to appreciate. So,
and the tax benefits. That's
Right.
another thing. I will show my soldiers, especially because they're like, oh, my BH is this, and I'm like, yes, but with your tax bracket, with this home, your average refund, and I have it all calculated. So if anyone wants to see that, it plugs in your information, and it's like $563 a month in a tax refund by owning a home, because the interest, the taxes, and the insurance are all deductible. So I'm like, yes, your payment is $200 more than you wanted, but now apply that $563, and now you're coming ahead.
yeah.
So again, it's just education.
I think that agents, especially newer agents right now, are really, really, really going to have to dig into learning more about the lending side. Obviously, be careful with that, because, you know, we're not lenders, and there's a lot of things that you can't do, shouldn't do, but like
at least
learning
you
how
know.
to talk about things the way that you're talking about things.
Right.
Like real estate agents are out there on Facebook all day long, just like, it's a good time to buy because I say it is, or just because
Right.
Or they quote an interest rate that's not feasible.
It's a good time to buy because it's a good time to buy, you know, and you have like actual data and reasons for why.
Right.
It's always a good time.
So I do teach classes for that, but only like 6 people attend, and they're really good. I teach like an hour long, 101 down to the nitty gritty of how much you can ask in concessions per the loan type. I go deep into that. And you know what, if you like my agents that understand this side of things, like I haven't worked with you, but I work with Angela. So Angela definitely does. The agent I worked with the longest, like he does my job for me, where I'm like, dude, back off. Like you left nothing for me. You already told them what loan type to go into. Like, I'm like, you know too much. Which is great, because he never has a buyer on the fence. Angela, you don't have I know you don't have sellers on the fence.
No.
I'm sure you don't have buyers on the fence.
Learned that though during the recession. Angela and I learned that during 2008 times together, and what we figured out was that the loan sells the house, really, right?
Yeah.
So
we both worked for a builder, a local builder here during that time, and we had to figure out how to sell their POS product.
Yeah, and it's all about financing and the money. Yeah, so I mean, I think that it's the time that you have to learn that, or you're not going to be able to.
Yeah,
and you hope that they work with a good lender, because what if they're working with their cousin that just got their license? They're not going to change lenders, and their cousin doesn't know what a bridge loan is. They don't know that they can still keep this house and buy a new house. They don't know they can use their VA loan again. You would not believe the questions that I see on these mortgage loan officer forums that I'm like, how do you not know this? Number one, Google it before you go on Facebook and look a fool. But number two, like if you don't know that a VA loan can be used again, please don't do a VA loan. Please move on. Send that to me and go do what you know. But it's like,
the good news that we keep talking about on the show is that right now we're in the biggest compression, as you know, in the industry as well. Because, you know, obviously most people that listen to the show are either agents or lenders, but this is the biggest compression. When you get to a 2008, or you get to what I think we will see in the next year to 2 years as far as attrition with real estate agents and loan officers, it does get easier, because the people who are highly skilled will be the ones that are around, and the consumer will pay more money in a recessed economy for someone who can help them do what they need to do, right? So you gotta level up on your education so you can make it through.
Well, in loan officers, we went from 480,000 licensed to 220,000 licensed to 70,000 that are still doing it. Here's the kicker, though, is that we still have the new ones coming in, and they have the time. I don't have the time to go. I'm doing more of it because I realized for my mental health, I needed it. I closed 600 loans last year, and I worked like a dog the last 3 years, 15 hours a day. I didn't have a team. I did 400 loans without a team, then got a team and got to that 6. But I lost myself. I didn't have time with my children. I almost lost my shit. I still think I might be in the middle of a nervous breakdown. Not sure yet. But I don't have the time. I don't have the time to be out there hustling up the agents and doing the lunches. And I do choose to do those with people that I want to spend time with, right? I'm not just doing with every Tom, Dick, and Harry. Well, the new guys, they have the time to do that. So you still have to be careful, because you are getting these new guys, which I love a hustle. I love a grind. Don't get me wrong, but they don't know loans. I have a couple of new ones on my team. They don't know anything, but they get the business, and then they have me to do it for them or walk them through, which is great. But if they don't have that, you still have to be careful. So I do think that we're compressing in a really good way, where The good people are going to stay. The new people are going to continue to grind to keep us old people on our toes to keep grinding. But you have to have a trusted person that has the answers, the correct answers quickly. Like with my situation, like here, I know 99% of the guidelines. And if I don't, I can have an answer in 5 minutes from my head underwriter. So you just want to make sure you have those. But yeah, get educated. Like I said, I have a one-on-one class. I'm happy we can do one on Zoom. If anyone's interested, I'll do whatever.
Yes.
You know, it's about an hour, like I said, and you get a really nice packet and it gets deep, but you really do need to empower yourself, because that is part of your job is the lending side.
Yeah.
You know, part of my job is the real estate side, but I'm not showing anyone else's because I can't.
Yeah. Also it sucks. But I think it's so important for agents. Once you understand the lending side, it's almost not fair, the advantage that you have over everyone else. Because most realtors don't value it. They don't understand why they need to know it. And they just think it's not my job. I don't care. But the second you master that side of things enough to where you're dangerous and you can speak intelligently, that is something that you'll always have. You're never going to like all of a sudden not remember, you know, like that's a big deal to be able to have that in your arsenal that other people won't have. So I really recommend it. And that's something that set Lindsay and I apart when we were selling new homes, is to be able to understand the lending side. We all of a sudden had a massive advantage over the entire city, because we could actually sell our homes and nobody else could, because of that. It's a massive tool in your tool belt.
And the clients will come to you with those questions, and no, you don't need to know guidelines and you don't need to know every detail, but you need to know what a bridge loan is. When they come to you and they say, hey, you know, can I buy a house before I sell this one? And you go, yeah, there's a thing called a bridge loan. Hey, I don't know the details of the loan. Let me get you with a lender, but yes, that's an option. Like you need to be, you need to have those options in your pocket. You need to be educated. You need to be able to have the answers, because if not, you're going to lose them. And I feel like with how the market is and people being nervous, like you've got to be on your toes. You've got to give them that confidence and that education that they feel like they're making a good financial decision right now, because they're relying on you for that way more than they're relying on me as a lender for that.
Yep. 100%.
Crystal, tell everyone what states you lend in and how they can find you, because you are
Thank
great.
you. I lend in all 50. So we are a federally chartered bank. I'm individually licensed in 44 because I'm crazy, but we are all 50. I personally can handle them in all 50. I'm not, oh, let me send you to a North Dakota loan officer over here. I do have a team if I get super busy that will help, with a couple of great loan officers that have been very well trained by MOA. And we do some cool stuff, construction loans, land loans. The all-in-one loan is definitely something I would recommend. That if y'all don't know what that is, I would recommend doing a class with me on that. That's going to be big. There's no hits for investment. There's no hits for cash out. That's going to be a really good loan. It's a first position HELOC. It's super complicated, so we can dive into it another time. But we do pretty much every loan out there. The DSCR, bank statement loan, asset depletion, doctor loan. We have a great jumbo 10% down to $3 million. So any of your out of the box stuff, we have it. We have the down payment assistance grants in all the states that they're available. So I don't know of anything we don't have.
Amazing.
Awesome. I think the other thing that you see this year is lenders moving to brokerages or other lenders that actually do have the programs that they need to be successful and have better interest rates, because there's such a massive difference between interest rates at different companies. And I think you're going to definitely see people moving to be able to offer those things so they can compete.
And not even just that too, like an LO that will like fight for your people, because there's so many loan officers that are used to just like cherry picking the best deals, and they'll just flat out like be like, I can't get this done. And then your buyers will freak out and leave. Right?
Yeah. A third of my business is turned downs that other people can't figure out how to do.
Awesome.
And that's just because, again, like I will fight for it, because at the end of the day, it's not about the paycheck for me anymore. It's about the, like, give me a gold star because I got it done. And it's about like the family getting into the home. I probably have cried at more closings than I like to admit, because I'm like, the sweet family, you know. So, and after 3 lenders told them no or whatever. So yeah, definitely the broker side is definitely becoming big again. It was huge during the subprime market. That's how I got started. And they have their things and we have ours. But I've been with this bank for 8 years. So I took a 6-month little hiatus, bad decision. And then I came back, but been here for 8 years, and and they're great. Everyone here is great, and they will fight too. The underwriters will sit on the phone and fight with me, like, okay, let's figure this out, you know. So it's important that you have that you have a team, that you have people that have your back, and people that help you when you don't know what the heck you're doing. Like I said, I have a couple of newbies that they don't know really anything. They've been in the business for a little while. They've never been taught. They have deals coming in. They're like, okay, here's the deal. What do I do with it? That's fine. Let's do it. You know, let me train you right. But yeah, you definitely need that support, especially in this market right now. Loans are so much harder right now than they used to be. Yeah. It's bizarre, but they are like, I get the craziest stuff out of the woodworks where I'm like, wait, what? You have what? Okay, let's figure this out, you know?
Yeah, for sure.
Well, everyone call Crystal if you need a lender across, and go take her classes and learn.
Yes, the classes are good. Yeah. I have a Chat GPT class coming on Tuesday. Follow me on Facebook, and then you can see all the stuff that we have. But also, if there's just something that someone's like, hey, I really want to understand credit repair. I do have a credit repair class, CE class coming next month too. But I try to do a class every single month. This is not something where I'm going after you. I won't even call to follow up, even though I probably should. If there are other agents are in there, they're not allowed to recruit. It's very just educational. That's it.
Awesome. Thank you so much for being with us today.
Thanks for having me.
Clearing some stuff up. You know, she spoke really, really knowledgeably and made everything seem less confusing.
Yeah, for sure.
Especially about the credit stuff that everyone's flipping out about. So, and again, just the amount of misinformation out there.
Yep, absolutely. Always an issue.
Yeah.
Well, thank you guys for joining us. We will see you next week. And hopefully nothing crazy happens between now and then. If it does, we'll talk about it. So
bye.
Angela and Lindsay would love to receive your real estate referrals in Colorado. Connect with the Homegirls on social media at The Real Homegirls